Yeah, welcome back. After 4 consecutive weeks of depreciation, the Nigerian equities market depreciated last week, shaking off the Central Bank of Nigeria's policy-induced rally. The Nigerian Stock Exchange All-Share Index fell by 0.54% to close at nearly 26,860 points, while market capitalization closed lower at 12.96 trillion naira. Now, the market recorded losses in all the 5 trading days, driving the year-to-date decline to 14.5%. Now, in terms of sectoral performance of the 5 sectors tracked, only the NSE consumer goods sector rose by 1.71%. NSE Industrial Goods Index recorded the highest decline. Meanwhile, the Acting Director General of the Securities and Exchange Commission, Ms. Mary Uduk, said the Nigerian capital market has the depth to revamp the nation's poor state of infrastructure. She said this while addressing the Capital Market Correspondents Association of Nigeria. Uduk further stated that the government has been doing its best to close the infrastructure gap as outlined in the Economic Recovery and Growth Plan, but private sector investment is also required. A report compiled in 2013 by the African Development Bank shows that Nigeria needs to invest about $350 billion in its infrastructure sector in 10 years to be at par with its peers. And joining me in the studio to discuss this is Michael Nwakalor, a macro analyst at CardinalStone. Michael, it's good to have you with us.
Good to be here.
So, SEC's comments lately on infrastructure development in Nigeria, how would you assess prospects there?
Yeah, so so I think they touched on a very important topic, which is the infrastructure gap. Estimates have it at around $3 trillion. And I think a McKinsey report basically said that Nigeria needs at least about $31 billion every year for the next 10 years to be able to close somewhat that gap. And that's equivalent to about 11 trillion naira. So it's a very salient point that she raises. And I think there's a lot of scope to raise funds from the capital markets. Especially as, like she said, the government alone cannot close that gap. True. So last year, the government spending was about 2.6 trillion naira on capex. But according to the report I just mentioned, we need at least 11 trillion. So that's kind of just scratching the surface. In fact, that 11 trillion is higher than our entire budget for 2020. So the gap is really wide, and we need to find more ways to close that gap. Yeah,
you're right. So just a one-off question here. Has the regulatory body itself been able to instill more confidence in the market lately despite recent downturns? I'm talking about the SEC this time around.
Okay, is this the capital markets? Or
Yeah, on the capital market itself.
Yeah, so I think the SEC has done a good job in terms of the liquidity that we see in the markets, and in terms of just the general regulations and how they enforce them. The NSE as well has kind of done its part. So we're seeing, so we've seen a lot more investments from institutional domestic investors in the last, so between July and October, it's gone up pretty significantly, about 10 billion more over that span of time. So we've seen a lot more participation by domestics, but the foreigners seem to be the ones who are not too confident about the market. And although they've increased their transactions, unfortunately, most of their transactions are outflows.
Indeed, Michael. Now, we've seen 2019 record a period of highs and lows and what have you. So what are the forces driving this narrative?
Yeah, so I think most recently the OMO ban has been the big, thing really driving the markets. Okay. In the last 5 weeks, I think the market has closed up 4 times and just closed down once, which was this week. We've seen a lot more participation, especially by retail investors and institutionals in the domestic market, and that has kind of turned, has kind of made the market turn a small corner, right? So it's gained about 2% in the last 4 weeks, and it kind of dipped by 54 basis points this week.
That's a marginal gain.
It's a marginal gain, but I think what's interesting is before that 2% gain over like a 4-week span, we had lost for 5 consecutive weeks right before, right? So, it's a small gain, it's a drop in the ocean, but it's something compared to what was going on right before.
Yeah, a drop in the ocean. So how have fixed income segment of the market fared as well, you think?
Yeah, so the fixed income market, last week, the yields on average declined about 44 basis points. And that has been pretty much in line with the trend that we've seen since the UMA ban on October 24th. Yeah. Yields have been declining pretty much week on week, I think with the exception of the week before last week. It's been pretty much constant. And, that's because domestic, individual, and corporates can no longer put their money in automobiles, so they're looking for alternative investments. And as we know, the bills market is not very liquid. The depth in that market is just about 2 trillion-ish. So what we're seeing is most of the funds actually going to the bond market, and the prices have been going up in that market, and so the yields kind of going down. And we saw the same play out last week in the bond market.
Now, what has been the impact of the restrictions that only the foreign investors can actually, be involved more in OMA deals?
Yeah, so we've seen the impact both...
Especially from the local players.
Oh, yeah. So we've seen the impact both in the equity and in the bond space. There's a lot more buying activity. Okay. People are looking at where to put their funds. So I think that PFAs right now have, I think, the most funds to kind of spend. As the last time I checked, their asset under management was about 9.5 trillion naira. And a lot of them are still kind of putting it in money market instruments. But we've seen a lot more kind of buying of bonds. Right now, they're a bit hesitant to enter, two-footed into the equities market, because of the weakness that we've seen throughout the year. But we feel that at some point, they would actually have to make a choice because, as we know, yields are below the inflation rate of 11.6%. Okay. 1-year yields are currently doing about 9.4%. And the money market rates that they get are between 8 to 9%. So at some point, especially with the liquidity that we expect to see in the coming weeks, this week alone, about 650 billion is set to mature. So at some point, we think that they're going to have to look for alternative avenues to allocate these funds if they want to get returns above the
Can you expatiate on the liquidity you mentioned recently for next week?
Yeah, so OMO liquidities have been coming in, right? And like we discussed, as these liquidities come in, they can't be reinvested in the OMO bills, right? Okay. So they kind of have to go somewhere else: bonds, bills, equities markets, alternative investments elsewhere. And we expect a lot more maturities in the coming weeks. In December, OMO maturities of about 2 billion is expected. Okay. So not 2 billion, 2 trillion is expected. And last week we got about 630 billion. This week we expect about 650. And in the coming weeks, we expect over 1 trillion to come in, right? So, and we estimate that about 30% of those belong to domestics and cannot be reinvested. So that money has to go somewhere. And at some point, if they keep going to bonds, the yields on those bonds are going to keep going, downwards. And at some point, it wouldn't make sense to keep buying those, and the money market rates as well. If they keep placing their money in money market instruments, banks are going to at some point have to reduce the rates that they are getting, and they're going to, if they want to preserve their return, they're going to have to look for alternative sources of investment.
Indeed, Michael. Now, bullish runs in Nigeria's market have been few and far in between. So, what are the major challenges here? You've already highlighted some, but what do you make of that development?
Yeah, so I think, our market is still semi-dependent on the foreigners, right? And what they really want to see is real traction in the macro space. Okay. So far, last quarter, our growth improved slightly, but it's still under, it's still under our population growth rate. Okay. It's still under our long-term growth rate of about 4%. So it's really underwhelming in that aspect. I think what investors want to see is a real commitment towards reducing or towards improving the ease of doing business, a real commitment towards a free and open market. Okay. For the power sector, the oil sector, they want to see more liberalization in those sectors. With the exchange rate as well, they want to see an exchange rate whereby when they come in, they wouldn't be too scared of a devaluation going forward. So they just want to see, I think, more predictability in the investment and more growth.
Okay. Now, on a final note, for average investors looking at current market dynamics, where would you advise them to put their money in?
That's a good question. That's a good question. So I think if they are more on the riskier side, I think some equity names are doing really well at the moment, especially in terms of dividend yield.
Okay.
So you look at banks like Zenith Bank, UBA, they have significantly higher dividend yields that you can get in T-bills, for example, and in the money market, right? So if they want investments that can yield above the T-bill rate and above inflation, I would say those names. There are some other names as well, but they have to kind of look at not just the dividend, but also the operating performance and some other metrics. And once again, it also depends on their risk appetite. Some people are forever comfortable with fixed income, so yeah, it depends.
All right. On that note, Michael Nwakalor of CardinalStone, I'd like to thank you very much for your thoughts on the market and other issues. Good to have you.
Thank you very much.